But then there's a question of exactly how markets are positioned. And right now it seems like, given the rally, we're kind of heading back to that Goldilocks expectation of the soft landing. How overweighted is this market to that outcome?
Well, yeah, I definitely think the equity market is still in a sort of very comfortable position in terms of the way that it's looking at the outcome of a sort of soft landing. And to some extent, that's reflected in the bond market because we're pricing for a low point, if you like, in the funds rate of around 3%. So it's like the Fed has to unwind its restriction. It doesn't necessarily have to get very accommodative. It doesn't have to go the other side of neutral, which would obviously involve taking rates down to 2% or even below. So in a way, both markets are sort of in the same sort of softish landing place, and that's obviously reflected in a lot of the positioning, particularly from the faster money crowd. I think a lot of the real money side may have sort of missed a lot of this rally, at least in bonds. I think the key issue, though, if you look at the sort of pace of Fed easing, is it's fairly orderly. I mean, the market's not quite convinced they have to go at 50 basis point clips every single meeting. It's sort of like these 25s sort of rolling out. And really, if you look at some of the labor market sort of models and stuff that even the Fed has put out in the past, I think one of the big issues for us is that we're almost at this kink in the labor market whereby as vacancies slow, unemployment could really accelerate higher if you're not careful. It's not happening yet, obviously, but if that happens over the next 3 to 6 months, then the Fed will have to be much more aggressive in bringing rates down. And neither the bond market nor the equity market are positioned for that very well at all. That's the key issue, I think.